Hi, everyone. My name is Linda Bennett. I am the Director of Account Operations and Partnerships here at Adrenaline. And today we are going to be talking about the financial industry. This is Financial Industry 101. This part one actually has 3 chapters in it that we will be addressing. What you can expect in this session is to get a baseline understanding about the financial industry. This is really meant to kind of be foundational knowledge so that everyone at Adrenaline can be more informed about the industry that we serve. Some of this may be a refresher, some of this may not be new information, but some of it might be. So we'll get started. We're going to be talking in chapter 1 just about a general overview about the financial industry, the products and services that our clients have, and the divisions within banks and credit unions. In chapter 2, we'll be doing a bit more of a deeper dive about banks specifically, credit unions specifically, and fintechs. And then in chapter 3, we're going to be talking about performance benchmarks. So understanding how an institution is performing based on certain KPIs and performance metrics. So we'll get started with chapter 1. This is meant to be an overview, right? So let's very simply start out with, what is a bank? A bank is a financial institution whose primary role is to, number 1, accept and hold monetary deposits from individuals and organizations, and number 2, lend money out. But what is a credit union? A credit union is a not-for-profit financial cooperative whose members can borrow from a pooled set of deposits at low interest rates, and their primary role is to, number 1, accept and hold monetary deposits from individuals and organizations, and number 2, lend money out. So the functions of a credit union and a bank are very similar, but there is a difference between a credit union and a bank. And what is that difference? Banks are owned by shareholders, while credit unions are owned and operated by members. So a bank has customers and credit unions have members. A bank is for profit, while credit unions are not for profit. Banks will pay taxes, while credit unions pay no taxes or very few taxes, depending on their charter that we'll get into later. Banks pay dividends to shareholders, while credit unions pay dividends to members. And because of that, banks typically offer higher fees and higher interest rates on loans, while credit unions typically have lower fees and lower interest rates on loans. Banks typically have lower rates on savings accounts, while credit unions typically offer a higher rate on savings accounts. So then what is a fintech? It's important for us to understand what a fintech is, because these are really disruptors within the financial industry right now. So fintech, very, very simply, is a financial technology company that includes products and technologies and business models that are changing the financial industry. It refers to everything from cashless payments to crowdfunding platforms to robo-advisors and virtual currencies. And as I mentioned, they're disrupting the financial industry and really changing the way that people are borrowing money and paying. So for example, you may have heard of companies such as Venmo, GoFundMe, Apple Pay, or Rocket Mortgage. And these are really changing the landscape here. So we're going to deep dive into products and services of financial institutions. Before we kind of deep dive into those products and services, I first wanted to just give you a couple of helpful definitions that we're going to be discussing as we go through this material. So the first is deposits, and the second is loans. So you may hear our clients talking about deposits. So deposits is very simply money placed into financial institutions for safekeeping. So it's made to deposit accounts such as savings or checking accounts or money market accounts. And loans is money borrowed from financial institutions such as auto loans, consumer loans, and mortgage. Now, products are also subdivided into personal and small business. So on the deposit account side, personal products are a personal checking account, a personal savings account, money market, or a CD. But a small business and a commercial or an enterprise can also have a checking account, a savings account, and money market. Then, when it comes to loans, there are personal loans, which are things like a mortgage, a HELOC, auto loans, and consumer loans. But small businesses can also have loans or lines of credit. And then commercial products are usually for larger accounts or larger corporations, and that can consist of commercial loans, lines of credit, equipment, mortgage or warehouse lending, or even ag loans. And ag loans stands for agriculture or farmers. So some of our clients are actually in rural areas where there is a lot of farmland, and in which case they would offer those types of agriculture loans to farmers in their market. Additional products that banks and credit unions offer are CDs, or certificates of deposits, which is similar to a savings account, but it has a fixed term and usually offers a fixed interest rate, and it's locked for a specific amount of time. So you can't pull money out for maybe like a year or 3, just depending on the term of the CD. And it's typically at a higher interest rate than a savings account. And it's also really good for a bank or credit union to have a lot of CDs, because that allows for a committed amount of deposits within that financial institution. Money market accounts is similar to a savings account, but it typically offers a higher interest rate than a savings account. You usually have to have a higher minimum amount in that account. And there's a limited number of transactions for a money market account, but you can also write checks typically, and have a debit card as well for a money market. Now, a home equity line of credit, or a HELOC, as many of our clients will call them, this actually leverages, just like it says, it's the equity in your home to provide funding to you. So most use this for home renovations. The good thing about this is that it's typically at a lower interest rate with maybe a 10-year payback. And so you can actually be a little bit more variable with how you use that money and as you see fit. And the good thing is too that it's typically fewer closing costs as well. So this slide here just talks a little bit about the other banking services that banks and credit unions offer. So from a personal side, you've got online banking, mobile banking, debit and credit cards, wealth management. And for small business or commercial, there's also services like corporate identity theft, business cards, payroll cards, insurance, treasury management, wire transfers, things like that. Money services that a small business or commercial business would need, right? So when it comes to deposit accounts, why are deposits so important to a financial institution? And what's important to understand is that deposit accounts are what enables financial institutions to loan money for profits through interest. So a customer who has a checking or savings account with a bank as their primary financial institution, or PFI, is more likely to stay a customer and open other accounts there. So they also are typically going to have a stronger relationship with that financial institution. And so they're more likely to open additional products. So if I have a checking or savings account, I'm likely going to also open an auto loan at that same financial institution. And so that just allows for me to have a longer term relationship with my bank. So oftentimes there's a lot of value in being a primary financial institution of customers. The other good thing is that gaining depositors is actually an indicator of long-term growth for the financial institution. So it typically means that this bank is in growth mode. And so a lot of times a bank or credit union will do what they can to attract new depositors at that institution by offering maybe interest rates on checking accounts. So for example, Capital One, they put out a promotion of 0.4% interest rate on your checking account, which is about 10 times higher than what the industry offers. But this is a way to incentivize people to actually have their checking or savings at that bank. So why are loans important to a bank? Loans generate revenue via interest rate and guarantees a long-term relationship with a given customer. So the most valuable loans is a mortgage or commercial loan for a business customer because mortgages are typically 15 to 30 years. And so that's going to be a long-term customer paying a lot of interest over many years. So a lot of our clients actually come to Adrenaline because they need help to attract more depositors. They may have a business objective at a bank or credit union to increase the number of deposits that they have at the bank. And so we can help them do this in a number of ways. One of the ways is through advertising and promotions. So what you see on this slide here is one that we ran for Unify Financial Credit Union. It was a free checking account. And the cool thing is that at the time, Unify was a sponsor of the LA Rams. So they were able to give away a free trip to a Rams away game if they opened up a checking account. And when it comes to United Bank, they were promoting that this is a free checking account that's actually free. So they're advertising that there's no fees associated with their checking accounts. On this slide, this is just a couple of examples of auto loan promotions that we've done. So for Arrowhead Credit Union, this is a 1.99% APR on an auto loan. We're always happy to lend a ride. For Yumi, we did a campaign around lending. This one says, better than a roommate who empties the dishwasher. It's true, our mortgage rates are that good. And then here's another one. Better than a buy one, get one free. It's true. Our auto loan rates are actually that good. Plus, enjoy no payments for 90 days. So they're trying to attract loans in this situation. So let's talk about a little bit about the organization of a bank or credit union. So we typically will work with a retail division. So a retail division is responsible for consumer and personal banking products. This also has to do with the retail operations at the branch, so staffing and services, all of the branch facilities, call centers, video call centers, any of the branch technology, as well as the culture of the people that work in those in the branches. And some of the job titles of this team are CRO. So you'll hear CRO, which means Chief Retail Officer of a bank or credit union, and branch managers typically report to the CRO. Sometimes they're also called CXO, which has to do with a Chief Experience Officer, because they really are in charge of that entire customer experience on a retail level. Another division is the commercial division. And so this commercial division is responsible for the specialty services to business clients, and this can be small business owners to large corporate identities. So this division is responsible for making loans that will enable business to grow and hire people, which of course that contributes to the expansion of the US economy. They also offer loans and credit services, treasury, cash management services, commercial real estate, etc. And so some of the job titles of this team is commercial lending directors or commercial loan officers. And you'll find that certain organizations, so certain banks will focus more on commercial versus consumer. Sometimes banks offer products and services to both the consumer or retail and the commercial side. So you'll have to get to know your customers to figure out where their focus is and how we can help them. The next that we also offer is, or the banks and credit unions offer, is an investment decision. And these are usually financial planners or wealth management planners. And so they offer trust services, investment vehicles, IRAs, 401ks, etc. So just as a recap, as we are finishing up this first chapter, this is just kind of some of the good to know call outs from the content that we just heard. So a PFI is an acronym that stands for primary financial institution, and that typically refers to an institution where a customer has their checking or savings account. Banks have customers and credit unions have members.